You see it on the news, right? A conflict flaring up thousands of miles away. It can feel so distant, almost abstract. But have you ever stopped to think about how those events could actually send shockwaves directly into your own bank account? Well, today, that's exactly what we're breaking down. How global tensions and financial markets are deeply connected.
And that really is the million-dollar question, isn't it? This isn't just some high-level economic theory. We're talking about your personal financial health. How does something happening on the other side of the world create ripples that can affect your savings, your investments? We're going to map it all out.
So, to guide us through this, we're going to be using a document from a financial services firm. We're going to walk through their analysis, piece by piece, just explaining their perspective as clearly and neutrally as we can. This isn't about giving advice, not at all. It's about understanding the mechanics, the why behind it all. So, let's dive in.
Okay, first things first. We need to understand the trigger. It all starts on the world stage, with that geopolitical spark that can ignite a fire of uncertainty in the markets. The source material we're looking at zeroes in on recent escalations in the Middle East as a perfect example. See, when major global players get involved in a really tense situation, investors all over the world, well, they hit pause. And that collective, widespread caution is the very first tremor you feel before the real turbulence begins. And here's the thing. This feeling, this worry, it actually has a name: geopolitical risk. It's not just some vague concern. It's a real, measurable factor in the world of finance. It's the official term for how international politics can directly harm your investments. And frankly, it's why a single news headline can sometimes send bigger shockwaves through the market than a huge company's profit report.
Okay, so we've got this big term, geopolitical risk. But how does it actually make its way from a headline to your wallet? Well, the path often starts with what we can call the oil domino effect. Let's trace it.
Here is the very first domino to fall. You have to remember, the Middle East is an absolute powerhouse for global energy. It produces a massive chunk of the world's crude oil. Our entire global economy pretty much runs on that oil, so any threat to its stable supply is a threat to the economy itself. Simple as that. And this slide just lays out the chain reaction perfectly. It's like a pipeline. First, the conflict creates fear about a supply disruption. That fear all by itself is enough to make crude oil prices spike. And since fuel is used for, well, pretty much everything, from shipping products to manufacturing them, costs go up across the board. And where do those costs end up? Companies pass them on to you, the consumer. The price of everyday stuff goes up, and that, in a nutshell, is inflation.
So oil prices are climbing, inflation is starting to bubble up, and the whole financial market starts to feel like a pressure cooker. So how do investors react when things get this heated? Let's take a look.
Well, usually the first thing you see is a market taking a hit. Think about it. Higher inflation can eat away at a company's profits, and all that uncertainty makes investors much less willing to take risks. That combination is a classic recipe for a stock market sell-off, which pushes values down, at least for a while.
And you've got to understand, investors tend to react in a couple of key ways. First, there's that gut reaction, right? The fear-driven selling that makes prices swing all over the place. But then there's a more calculated move, something called capital flight. This is when investors intentionally pull money out of what they see as risky stocks and start searching for safer places to park it. Okay, so things are volatile. There's a lot of uncertainty. What on earth is an investor supposed to do? Now we're going to shift gears and look at the game plan that our source document suggests. Let's break down their strategic response.
The number one piece of advice coming from this source, it's pretty simple. Don't panic. The document argues against making emotional knee-jerk decisions. Instead, it pushes for focusing on a long-term strategy, making sure your investments are spread out across different areas, and, most importantly, sticking to the plan you made when you were calm and thinking clearly, not in a moment of fear.
Now this is a really interesting point, and it might sound a little backwards at first. While a lot of people are selling out of fear, the source suggests that a market downturn, what they call a correction, can actually be an opportunity. For investors who are in it for the long haul, falling prices can mean that quality investments are basically on sale, giving them a chance to buy in at a lower cost. So remember that capital flight we talked about? When people are looking for safety, where do they put their money? Well, this source points to a few classic safe havens. These include things like debt instruments and government bonds, which are generally seen as more stable than stocks, and also commodities, especially precious metals like gold and silver, which have a long history of holding their value when the economy gets shaky. All right, as we start to wrap up our look at this document, it's really important to see how the source itself finishes up. It ends with two key things: a call to action for their own services and a standard industry disclaimer. Let's look at them both.
So the document's call to action is pretty straightforward. It encourages anyone who wants to learn more about how to position their investments during these uncertain times to get in touch with the firm that actually wrote the analysis.
And finally, of course, there's the mandatory disclaimer. This is the part that reminds everyone that all investments, no matter what, come with market risks, and that it is absolutely essential to read all the related documents carefully before you put your money anywhere.
So we'll leave you with this final thought, which really gets to the heart of the dilemma for any investor. When the world feels uncertain and markets are choppy, what's the bigger risk? Acting out of fear and potentially making the wrong move, or being paralyzed by that fear and making no move at all?